All right, so again, following our process, if we're debriefing Raytheon, Lockheed Martin, and Transdigm, most of the numbers are pretty straightforward, except if you went into Raytheon, RTX US equity, went to EEO, and you started looking at return on equity. And what you'll start to see is the problem is the next 3 years, there's only 3 years in here, is not a fourth year, is that essentially they're being kind of weighed down coming out of the pandemic as the commercial airline business is still in a recovery. And you'll notice that their PE is still reasonably high. So if you have a relatively low spread, given their current cost of capital, you're going to need a much higher G to explain that PE. Okay? So one thing that you could do, or should have thought about doing, would have been to look historically at what, because these are pretty mature companies that have been around for a while, like what they were doing pre-pandemic as more what might the market think as a representative level of return coming out of the pandemic. So if I went to FA, and I went to custom, and I typed in create custom, if I did a return, let's spell return correctly, return on invested capital. Now this is not operating ROIC, but at least it's, close to that. And if I did a return on common equity, and let's say I went back 10 years, then I can see that pre-pandemic, the Raytheon Technologies business combined was averaging an ROIC somewhere in the low teens, 10 to 12%, and their return on common equity was around 20% plus or minus a few points. Okay, so somewhere in the 12-ish range and the 20-ish range, it could be high teens, mid 20s, I think would probably be more reasonable if we're trying to explain the trading multiple going forward than if we just did something like an average of the 3 years that were out there. Because they're still recovering from the pandemic, and I think people believe that post-pandemic that they will have fully recovered, and I think their trading multiples are probably more representative of that. So we would have needed to come up with, and what I did here is I used 20% for ROE, and I used 12% for ROIC for Raytheon. I gave them credit for being close to the top end of their historical range going forward. Right? But again, you could have chosen slightly different numbers, but if you were somewhere in that range, you still would have gotten a G somewhere around 4%, because that's the problem. If the spread was lower, then the G would have been higher. And when that G starts getting to 5, 6, 7%, I'm not saying you can't have one. We had that clearly for Nike and Lululemon, but the problem is Raytheon's not a Nike. Okay, they're just not growing at that rate on a go-forward basis. The athleisure market and the defense market are completely different markets. So therefore, this is probably more realistic for a Raytheon to explain the multiples. Did anybody get close to these numbers when you guys were trying to put some pieces together? Okay. Then we go to Lockheed Martin, LMT. LMT has a different set of fleas. Okay. So the challenge with Lockheed Martin, when we go to EEO, is that their return on equities are extreme. They get to like 95, 100% on a go-forward basis, right? And if you start to poke around on their actual balance sheet, what you see is what I've been telling you, which is Lockheed Martin basically takes 80% of their free cash flow on a quarterly basis and distributes it as dividend or stock buyback. So what they've been doing is they've been basically wiping out their equity quarter over quarter. So they have a distorted balance sheet because they've been buying back so much stock at market prices that it doesn't look like they have hardly any equity at all. Okay, so that return on equity of 100% is in a way distorted because they've been buying back so much stock to increase their earnings per share growth. So what is a reasonable return on equity for Lockheed Martin? Well, their operating ROIC, let's assume is fairly consistent, is around 32% today, okay, based on our calculation. So let's assume that today actually kind of looks like tomorrow for Lockheed Martin. They didn't have the Raytheon problem with the commercial airline business. So if we're in the low to mid 30s, anywhere from 30 to 35%, you're not going to see too much of a difference there. Then the question is, what return on equity would that represent? Well, if I looked at the WACC screen, Lockheed Martin right now is about 90% equity and about 10% debt. Okay, so practically, if I take 1 divided by 0.9, it's like multiplying by 1.1. Okay, so basically what it's suggesting is their return on equity, if they weren't buying back so much stock, would probably be closer to the mid to high 30s, as opposed to 100% because they're buying back all the equity historically. Does that make sense? On a go-forward basis from a cash flow standpoint. So for Lockheed Martin, what we would probably do, what I did, is if I use a 32% ROIC, then the ROE is closer to 35. Okay, that's what I would just call more like a synthetic ROE. That's the more realistic ROE that you're getting because of the level of historical stock buyback that they've done that manipulated their accounting books. Because when you deal with book value, weird things can happen. That's again just reinforcement why PE is a challenging ratio, right? Because again, PE can be influenced by accounting, can be influenced by book value versus market value, can also be influenced by interest expense and capital structure. So essentially, we have to kind of figure that out. So if I think the ROIC is pretty stable, figure out what the ROE is based on a capital structure. That's what I would have done for Lockheed. Did anybody come close to these numbers when you guys were poking around? Questions about this? How I got these numbers? Yes.
Why did you multiply by 1.1?
Well, if they're 90%, just think about this formula that I put here. Where did I have that formula? Just because I'm doing this on video and they can't see on the video when I'm pointing at the board. So, draw. If this was, as I said, loosely profit, now again, this is no plat, over invested capital times total invested capital to equity equals profit over equity. Again, knowing that the profits aren't identical because one's no plat, one's not net income, but I'm kind of in the directional area here. But the idea here is if this is 100%, and this is 0.9, then 1 divided by 0.9 is about 1.1. Okay? I could also take my ROIC and divide by 0.9, I get the same answer. But the point is, I'm taking the ROIC and I'm levering it up at a capital structure to infer an ROE. Okay, so that's the point. If they have about a 33% ROIC, given they don't have much debt relative to their equity and their market capital structure, then basically their ROE is just going to be slightly above. So it's not going to be 90%, it's going to be in the mid-30s. Now here's the interesting part of this. If you had actually put in 95% for the return on equity for Lockheed Martin, notice, look at what happens to my PE. Right now it's 17.26. It jumps to 17.81. Okay, so if you'd actually used it, as I said, when you get above 30% for ROICs and ROEs, it actually doesn't have a huge impact whether you're at 30%, 40%, 50%, 60%, 70%, because implicitly what's happening in that perpetuity is when you have extreme ROICs or return on equities, you have very low reinvestment rates. And the perpetuity is driven by how much you're reinvesting and what return on that reinvestment you're getting. And so if you don't have any reinvestment, okay, then it doesn't matter what the return is, you're not going to get a lot of cash flow on that reinvestment. Okay, so therefore your G is going to be lower. Right? Because remember, if you're paying out a lot, you're not reinvesting. Okay? And if you're not reinvesting, you don't drive a lot of cash flow from that reinvestment. So that's the point. When you get to extreme returns on investment, it doesn't actually change the values in the DCF all that much. Does that conceptually make sense to everybody? We can do some math examples here, but that's what's kind of going on with Lockheed Martin. So again, whether you did 95% or 35%, it's not going to affect it too much. And the answer that you're going to get here, again, I'll just goal seek this out. So I'm going to set that back to 17.81 because I changed it. By changing the G, you're still going to get a G below 2%, right? And that's going to be key, and for purposes of the analysis, when you did your analysis here, the key to Lockheed Martin is why it's trading at a discount to Raytheon is because they have lower than expected growth, lower G. It's below 2%, and Raytheon's G is above 3%, okay? So essentially, even though Raytheon's got a lower spread, that higher G gives them a better multiple than Lockheed Martin, okay? But that's the point. If you go read any of the analyst reports about Lockheed Martin right now, they're worried about the growth. They're like, where's all the growth going to come from in the future? And there's just a whole bunch of growth clouds on the horizon for the company. They made extreme returns, but they're no longer growing those returns. So it's consistent with a low G that we're seeing here in the multiple analysis that we're actually explaining their trading multiple in the real world. All right. Final company was Transdigm. So if we go to TDG, and we started looking at following our process, and we look at these return on equities, you're like, oh geez, what am I going to use for the future? These are all over the place. I feel like I'm on a roller coaster, right? Negative 100%, positive 100%. What do I use? So that's the problem, is you really can't use these 4 years to be representative of what's in the future, because they're even more impacted than Raytheon was by the pandemic, because they're primarily supplying to the commercial airline industry. They don't have as much defense exposure. So they were really on their back and they're recovering, but they're not trading as if they're on their back, they're trading as if they're recovering. So back to, if I go to FA and I look more historically, because they at least have a history as a more mature company, then when I looked at my custom return on invested capital, now again, this is an operating ROIC. Unfortunately, Bloomberg won't let us do custom formulas on historical data. 10 years. Doesn't have an ROE, but you can see that they get into somewhere around 10 to 12%, as high as 15 going into the pandemic, but no ROE historically. But here's the point. If I know this is a 10 to 15% ROIC, I could put a leverage ratio to come up with an ROE. So what I did here is I used a 15% ROIC. I gave them credit for going back to the top of their range. And then given their debt to equity ratio, which was closer to 60-40, they have more debt than Lockheed Martin does, that translates to about a 25% return on equity if that's the normalized rate that they get, and then solve for the G's. So when you do that, as I said, what you'll start to see here is that these WACCs get pretty consistent across these three companies. So the real differentiator here is spread and growth. So why is Lockheed Martin trading at a premium to, Raytheon trading at a premium to Lockheed Martin? It's all about their 4% G versus the 2.4% G. Why is it trading at a slight premium to TDG? And the answer is, even though they have similar growths, they at Raytheon, they have a lower tax rate. The 25% versus the 19% tax rate makes a difference there. Okay? And that's actually getting them more cash flow and a slightly better multiple for other numbers that are pretty similar. Why is Lockheed Martin trading at a discount to all the companies, Raytheon and TDG? Because they lack the growth. And that's consistent with what we saw with the low G on the PE side as well. And then when we look at what's driving the EV to sales ratio, why is TDG having a high EV to sales? Look at those operating margins that are expected to be 43%. They're just very high margin is the part suppliers. So people are paying a big premium for their sales. It's pretty clear for that. Why is Raytheon and Lockheed Martin, why is Raytheon's EV to sales higher than Lockheed Martin? That one doesn't make any sense. Okay, because Lockheed Martin actually has a higher margin than Raytheon. Lockheed Martin has better productivity than Raytheon, and Lockheed Martin has a similar cost of capital to Raytheon, yet their EV to sales is lower than Raytheon. Conceptually, that shouldn't happen, but it did. And so that's the other part of the messiness. So even though our academic formula says that this doesn't make sense, we're seeing this anomaly happening in the real world today. Okay, so what could be behind this anomaly is the market must be expecting higher margins from Raytheon going forward. And that goes back to the same idea at TDG, is that as the commercial business comes back for Raytheon, half their business is commercial. That's a much higher business than margin business than defense, and people are giving them some credit for that, even though it's not showing up in the next few years' numbers. Okay, so that's how you would have to explain this. I would call this messy multiple analysis, right? This is like making sense, out of a bunch of things that are tougher to do. The Nike one was much more straightforward, okay? But nonetheless, when you deal with the real world, you gotta explain both. Okay, questions, comments, concerns about any of that? So here's the point. Your homework 12 extra credit is gonna be messy. It's gonna be on airlines, right? And I'm just telling you, you might have to do some looking back to come up with going forward, because some of these numbers may not make nearly as much sense. Okay, so again, I'll post that assignment a little bit later today. You got the day Wednesday to use the lab. Turn it in by Wednesday night, which is your data plus your paper. I'll put in some sample presentations later in the week for next Wednesday's Dentsu. Take advantage of Wednesday and Monday to work with your teams on this as well. 6 companies across the 2 segments, 2 companies per segment plus Dentsu in the PowerPoint presentation. Take advantage of the TA's office hours later this week as well, and I'll see everybody a week from Wednesday. All right, this has been recorded and posted online.